for joining us for this quarter's market review. My name is Jia Ling and I'm a client advisor at Providend. For this market review, we will be covering the months from July to September, and I'll be inviting our head of investment, Chye Hsern, to share with you how the markets have been for the past 3 months. And thereafter, I will come back to wrap up the session. And all right, I will now pass the time to Chye Hsern.
Right. The third quarter of 2025 has been a spectacular quarter for markets. And in this brief presentation, we'll just be running through what happened in the markets, what performance various indexes and funds did, and just to give a little bit of insight as to why markets behave like this. And so if you look at equity market performance across various countries or regions, you can see that over the third quarter of 2025 alone, we had some spectacular results. If you look at China, it was up 20%, right, in the quarter. The US did very well, up 8.5%. But of course, emerging markets were the superstar. China up 20%, South Korea up 14%, Taiwan up about 11%. So that was a very, very strong performance, which led to the emerging market funds and indexes doing very well for the quarter. Of course, Singapore has been no slouch at all. Our market has done very, very well, up 11.7%. Hong Kong has also done well at 8.8%. Japan, UK and France, all part of the developed markets, all doing quite well. Of course, the US still leading most of the developed markets. So, I mean, a lot of this has been really due to the continued rebound in markets after the fall in April. I think, first of all, the impact of tariffs has not really come through in a lot of the data yet. So what we are seeing is that after a strong reaction in April, investors have started to look at the numbers and realize that the tariff impact has not yet really passed through into the markets and into companies' numbers, and earnings have been fairly strong. But a large part of it has also been a lot of continued optimism around AI. As you can see, AI both from the US and also AI in China. So China's market rally has also been led by the fact that they have had a lot of strong breakthroughs in terms of AI chips, in terms of AI models. And for the US, there's also been continued investment into the AI space. Companies are continuing to build data centers, spend a lot of capex, and that is boosting the chip makers in Taiwan, in South Korea, and then of course boosting the companies that are likely to benefit from AI in the United States. So all those reasons have led to a very, very strong performance for markets in the third quarter. But if you look a bit deeper and you look into the underlying factors, what we can see is that there have been some companies that haven't done so well despite the performance of the market so far. So you look at large cap value stocks, they've actually underperformed the S&P 500. So how do you read this chart is that this is the performance of that sector over the S&P 500. So in this case, it doesn't mean that large cap value stocks fell over the quarter, but what it means is that they did worse than the S&P 500 by about 3%, while small cap growth companies, small cap value companies did better than the S&P 500, and of course large cap growth companies did better than the S&P 500. So what this is showing is that there has been a strong rebound in terms of small caps on that, the economic data has not been as bad, and also market optimism over AI has led the large cap growth stocks higher. But unfortunately, the large cap value stocks, in terms of the more stable manufacturing companies or utilities companies, maybe have not done so well over this period. This is mostly for US markets, which is a large part, of course, of our portfolios because of the big weight to the US in the global indices. So still very relevant across our portfolios. And as you know, Providend, we do have a small tilt towards small caps in our portfolios because of the dimensional funds that we use. So as you can see, the small cap factors doing well. And then also we do have a tilt to value in our portfolio. So, well, part of the value proposition, the value factor is doing well, but the other part hasn't been doing as well. But overall, it does mean that our portfolios have been doing fairly well in the third quarter and are performing very, very strongly. Next, I'd like to briefly touch on fixed income. So fixed income is these bars here signify the fixed income yields of various countries. I know it might be a bit hard to see this, but the blue bar here, the blue line, sorry, is the US yield. And this pale blue line is the Singapore yield. And the green line is Euro, right? And the red and the white lines are China and Japan. So what you can see is that the yields have actually been very, very stable over the course of the third quarter, but the US yield has fallen ever so slightly. So fixed income has done a little better over this quarter, but the yields have generally hovered above 4% for the US. But it's steadily come down over the quarter, signifying that investors continue to be fairly calm about how the credit markets and the fixed income markets are working. I mean, Singapore, obviously you can see that our yields started to fall until almost the end of September, and then they sort of just came back up a bit. So, but overall, most of the treasury markets have been fairly calm. Of course, the expectations are that the US will be looking to cut rates in the future, and that is something that we are seeing already start to be priced into the markets. However, the expectations are so far that there are going to be about 3 rate cuts this year. One has already happened, 2 more are likely to be on the way. So most of that's already priced into markets, priced into the yields that we see today, which are still hovering around these levels. So what we can see from that is that in terms of the fixed income side, it's likely to be stable, and that the long-term fixed income markets are not really reacting very sharply towards the cuts that are happening in the shorter end of the curve. So lastly, I'd just like to share the actual fund performance of the funds that are in our portfolios. As you know, we use the Amundi index funds, which is the Amundi MSCI World Fund, the Amundi MSCI EM Fund, and the Amundi Global Aggregate Bond Fund. These are funds that are in our portfolios that track various indexes like MSCI World, MSCI EM. And we also use the dimensional funds, which are globally diversified funds that are very, very diversified, and they have tilts towards value and small caps. So you can see this is the Global Core Equity, this is the Developed Market Stock Fund, Emerging Market Fund, and then the Core Fixed Income Fund. So what we can see from this is that over the third quarter, we've had a very, very strong period from July all the way to the end of September, where developed market stocks have gone up more than 8%, and emerging market stocks have gone up 11 to 12%. And that's across all the funds that we use. So across our portfolios, which are comprised of these various funds, depending on how much stocks you have and depending on how much fixed income you have, you will see varying degrees of return. But rest assured that your portfolios are capturing these returns depending on what kind of allocations your portfolio has, and they have been delivering the returns to help you reach your goals. What we can see is that so far into October, the markets continue to be strong. This is already moving into the fourth quarter. Markets continue to be strong. We continue to see news about investment into AI, and that continues to give the market a lot of confidence in the AI trade. And so that's continuing. And what is key at Providend is that we remain globally diversified, and we are able to ensure that no matter what environment or what part of the market is going up or doing well, your portfolio is going to capture the returns. So if you look at the previous slide here, right, it depends. It doesn't matter if small cap growth is doing well, large cap growth is doing well, or small cap value is doing well. We are diversified. We are able to capture all these different factors performing well. And yes, there is one part of the market not doing so well, but because you're not in that strategy only, right, you have a mix of all these various things in your portfolios continue to deliver good returns, right? Because value stocks, large value stocks are inside here, they are inside here, right? But they continue, yeah, but yet despite that, you have a 8% return, right? In your developed market stock funds. And therefore, that's the benefit of staying diversified and staying invested over the long term. Okay, thank you for watching this market review. Hope that it has been informative and helps give you some insight into what's going on in the markets, and especially for our clients, give you the assurance that your portfolios continue to help you achieve your Ikigai goals. Thank you.
Thank you, Chye Hsern, for the insightful market review. With the strong performance of the equity markets in Q3 of 2025, you will be wondering, is this still a good time to invest given the all-time highs of the market? So now, let's dive into what the evidence have to say. Let's take a look at the average annualized return of the S&P 500 index over the period of January 1926 up to December 2021. So over here, this chart shows the 1 year, 3 year, and 5 year subsequent returns after the market declines of more than 10%. As you can see, the data shows that subsequent returns have been good after the market declines. And if we were to look at how market react 1 year, 3 and 5 years similarly, after the new market highs, you will see that the returns look similar. And why are we sharing this with you? It's because being an investor ourselves, we understand how it feels when to see your investments drop immediately after we invest. But the thing is, it is almost impossible to tell how the market is going to perform from year to year. However, there are clear evidences that show that if you are invested into a cost-efficient, globally diversified portfolio over the long term, your investment success would be excellent. Here's the growth of a dollar based on the performance of the MSCI World Index over the period of 1970 to 2021. And you can see that a disciplined investor looks beyond the concerns of today to the long-term growth potential of market. Now, if our concern is that markets are at their all-time high, one way to help us make the first step is to invest in tranches or divide our investment amount over a period, say 6 months. It doesn't help the investment return over the long term, but it gets us started in the important step towards enhancing the return of our money over the long term. Here is a comparison between lump sum investing versus dollar cost averaging. I'll be sharing with you 3 chart patterns. Generally, if you take a snapshot of a market, it will look like one of these. Firstly, market tends to go up over the long term due to the increasing demand for goods and services brought on by a rising world population, benefiting from higher standard of living. In the short term, market can and do go down from time to time. In the medium term, while recovering from a market downturn, it will form a U shape before recovering from the downturn. From this chart, we can see that in a declining market, take 2008 financial crisis as an example, the DCA approach has done better than a lump sum investing approach. You will still have lost money, but remember that the loss is temporary unless you need it or panic and sell everything. Moving on to the second chart, when market recovered from the crisis, once again, the DCA approach triumphed over the lump sum investing approach to give you a relatively decent return despite having to invest in the greatest financial crisis we have seen since the Great Depression. The key here was to keep investing when the market was down, and you would have benefited when it recovered because your costs will be lower. Now, let's look at the rising market chart. This is where the lump sum investing prevails. Incidentally, over the long term, the stock market charts look like this one, and thus, lump sum investing will be superior for the long-term investors. So, if you are worried about the market crashing soon, think about using a dollar cost averaging strategy. If you have a long investment time horizon and a strong emotional constitution, consider investing in a lump sum. But if you cannot decide which one you would prefer, simply just do both. Last but very importantly, do align the time horizon of your goals with the right instruments. For your short-term needs, do consider investing into low-risk investment instruments such as the fixed deposit, T-bills, or the Singapore saving bonds so that you are not overly subject to the volatility of the financial markets. And for your long-term goals, it is important to capture the return of the equity market while mitigating the inflation risk. And any time horizon in between, it is good to have a mix with bond allocation. And it is very, very important to make sure that you are globally diversified. This is not only to manage the risk, but to also ensure that you capture returns when they show up. As usual, if you have any questions or thoughts after this, feel free to approach our team and we will be more than happy to have a conversation with you. Thank you.